Hi. In this expiry option selling strategy that we're going to discuss now, try to focus more on when to exit the strategy or when to exit the position rather than focusing upon the entry point, because more important in this strategy is to knowing when to exit at the right point. And this can be deployed in Nifty, Bank Nifty, and you can also try it out in Fin Nifty. But as of now, the liquidity is not so great. Once the liquidity improves in Fin Nifty, then you can test it out there as well. So everything has been explained in the video in a step-by-step manner as to when to deploy it, how do you adjust it, and when to exit the position. And at the end, I'll be also covering as to what are the VIX levels at which this strategy can be deployed for a better results. And let's get started. So logic behind expiry day strategy, which is we do shared one strategy, which is expiry day. Yeah, here it will be. So on the pinned message, if you go and check it out, so there is an expiry day strategy, which is expiry day butterfly strategy, which is the option selling strategy, which is suitable only for the expiry days. Now look at it, what it is saying. So this one between 9:20 to 10, you can deploy at whichever the time possible, depending upon the experience, you will get to know that. But let's say you chose to do it at 9:30. What you need to do, you need to sell 2 lots of at the money call option and buy 1 lot of in the money call option and buy 1 lot of out of the money call option of equal distance from at the money, which is, let's say if I have to create that in Sensible, let's imagine that today is the expiry day and then you are creating that in the Bank Nifty and market is around 42, around 9:30, the market is around 42,437. So what is the rounded off at the money price? You have to round it off to the nearest at the money, which is 42,400. Now this will become at the money, right? Then you have to go for build custom strategy. 42,400, you will sell call option. How many lots? 2 lots you will sell first. Then look at this one. Look at the value. It is showing us 322 rupees is the value. See, whenever this value is somewhere close to 320 or 325 like that, that means if this value is somewhere close to 22 or 25 like that, round it off to the below one. Now here you can round it off to 300. If it is, let's say 350 or like that, then round it off to the next one, which is 400. So now in this case, if it is 322, you round it off to the 300. What is this 300? This 300 says that from this level, you have to go 300 points upside and then buy 1 lot of call option. And from this level, you have to go 300 points downside and buy 1 lot of call option. So let's do that. 1, 2, 3, let's buy 1 lot. And from here, 1, 2, 3. So here you sold 2 lots of call option, and depending upon this premium, you're rounding off that premium. And if it is 300, you're going 300 points upside. Let's say on expiry day, the values will be a little bit lesser. Now it is 300, but obviously on Thursday, that value can be somewhere close to 120 or 150 like that. In that case, you can round it off to the higher multiple, which is 200. Then you will be going for 200 upside and 200 downside. Now when you do that, you will be getting something called as it looks like a iron fly, but it's not iron fly. It is called as a butterfly strategy. There is a much difference between the iron fly and the butterfly strategy. Now this is called as expiry day deployment. This is the deployment. Now what can happen? The benefit of this particular thing is, let me tell you the benefit. On expiry day, that is the only day, like market will, the premiums will, time value will go to 0. There is no other day that we can extend for. The benefit, what can happen here is, if let's say the market went up by 0.5%, look at the profit or loss. You're not getting any loss, even if the market is moving by 0.5%. So for example, if market went by 0.5, you're not getting any loss. It's almost at a break even only. But let me tell you, if instead of this, if I do this is looking like an iron fly, right? let me do the same thing for the ironfly. Let me go to the strategy builder. And instead of this, if I deploy iron butterfly, this is how it will look like. Now, I'll do the same thing. If the market goes up to 0.5 on this particular day, now if it is going to 0.5, now I am facing some small loss. Even if it is slightly loss, both are losses only. But look at here the loss is almost close to 26 rupees. Here the loss is close to 270 rupees. So what happens in case of ironfly and this call butterfly strategy is, here the loss and profit will not be very quick. Profit also you will not get quickly, loss also you will not get quickly. Even if the market is moving up or down, it will be almost neutral only. Mostly the call butterfly will give you profits. It will start giving you profit after 1 p.m. or after 2 p.m. Then what happens? The delta of the call butterfly will become higher and higher. Then what happens? Let me tell you. This is the range that you will be having it, right? Let's say around, this is the range, for example. Now here it is, let's say 42,000 and 43,000. Now there's 1,000 points of a range. Bank Nifty is, let's say, on expiry day. Most of the times what can happen on expiry days, markets will reverse most of the times. Now let's take last 4 expiries. What is the date of expiry? Okay, let's take it here. What is the date? Let's go for, which is recent expiry was on over here, right? Okay, look at the reversal. So look at the type of momentum that happens. This was on 17th of November. That V-shape thing, if it is visible, then there is a very much possibility that your call butterfly will be giving the profit. This V-shape thing is important. Now this was possible on this particular previous Thursday. Let's go back to 1 week before. That means the previous to previous expiry date. The Monday, Friday, and this was the Thursday. Look at the V-shape recovery. So this is the V-shape. So whenever this kind of a V-shape comes now, then there is a probability that your call butterfly will be giving you a good profit. That to look at like more. That too, especially in the afternoon sessions, you are seeing it, the recovery. And again, let's go back to Thursday, right? And the previous Thursday would be Wednesday and Thursday. So here what happened? The V-shape recovery was not completely, towards this opening level, but there was some kind of a recovery that happened around this area. So there are 2 ways to manage this particular thing. One is by doing adjustment. One is by not doing adjustment. Adjustment is a difficult or slightly complicated process wherein you need to move it little bit. You need to either when the market is going up, you need to calculate the delta value, and then you need to sell put option. If the market is going down, you need to calculate the approximate value, not based upon the delta. Sometimes we also look at the premiums that is trading at that point of time. And if the market is going down, you need to sell a call options approximately to that particular value to match that particular value. But we don't talk about that now. We talk about without doing adjustment. What happens is, let's say around 9:30. So what is the time here? Before 10 o'clock, you can do. Let's imagine you did it at around this area when the market is. My suggestion would be, whenever you see a complete big bull candles, don't deploy that at the beginning. Don't deploy at 9:10 or 9:20. 9:20 or 9:30. Don't do that. Wait for some pullback, some consolidation before 10 o'clock. Try to deploy around that area. Whenever you see complete range candles, no, don't deploy immediately at 9:30. It is not an exactly time-bound strategy. It is better to wait for some quick pullback. Then you may do it. That works better rather than jumping into the trade at a specific time. Now, what happens is, if you deploy here, you have a range. This range will be there. So if at any point of time after 1 p.m. or after 2 p.m., if the market is coming back into this range, even for 1 minute, that means after 2 p.m., if the market is there inside this range, even for 1 minute, you will be getting a good and decent profit, which can, that means like 1:1 or 1:2 or sometimes 1:3 is also expected. That means as and when it is coming closer towards the 3 p.m., your profit potential will go upside. So remember one simple thing, from whichever the point that you deploy, you will have some range like this. At before the market, after 2 p.m., if the market is coming towards this range, even for 1 minute, at some point of time, if you keep on tracking the MTM profit or loss, at some point of time, you will see the profit. You can book that profit if you are getting 1:1 or 1:2, or let's say if you are getting 2% of ROI of your capital, you can book the profit. So the thing is, if you are not doing the adjustment, you need to be very careful and wait before 3 p.m. at any point of time, whenever the market is coming to close to your deployment level. This is where you're deployed. Whenever due to V-shape recovery only that can happen, right? So that means either the market has to go up like this and then do the V-shape recovery, V-shape reversal, or market has to go down like this and then do the V-shape recovery. So whenever this V-shape things forms on the expiry day, after 2 p.m. especially, and if the price is coming back to your opening deployment level, that is when, even if it's for 1 minute, you will see the very quick profit. And let's say you did not book the profit and market went up like this, you lose the entire money. That means the profit will turn into loss immediately. So you need to be very quick over there to book the profit, especially in this strategy. So that is how this works, especially on expiry day strategy. This cannot be deployed on other days. Only on expiry day this is suitable. Because even to do that is without adjustment I'm talking. Sometimes what can happen is market can keep trending in any one particular direction without doing a reversal or a retracement. In that cases, if you're not doing the adjustment, you may end up at a loss. But make sure that whenever you're deploying, you need to be ready to be able to accept the max loss. So how to check the max loss? Now look at this. Now this is my max loss. 1,300 and 1,100 is the max loss for one lot. So like that, let's say if I can take a max loss of 4,000 rupees, what I'll do, I'll increase this. I'll just multiply lot multiplier 1, 2, 3, approximately 4. Now let's say if I can risk up to 4,500, if it is within my 2% of the risk level, then I can take like 4 lots and do this. Now what happens is, let's say market is at around 2:30 p.m. and market is trading over here on upside. But due to a quick fall, suddenly the market reversed. The moment the reversal comes now, immediately, even if I'm having a loss of, let's say, like 3,000 or 4,000 of a loss at this point, immediately when the market comes here, you'll get a profit of 10,000 or 15,000 or 20,000 because your max loss is 25. So you'll be getting a profit of 15 or 12 or something like that. Immediately you can close it off. But if you are waiting for it too long without thinking that you may get even more profit, there's a chance that market can either go down again or go back on upside. In that case, again, you will be at a loss. So this is a strategy which as and when you deploy, you will get to know more thing about it. There is no default way to, like, it's not like you deploy at 9:30 and then close it at 12 o'clock like that. As and when you keep watching it, at some point of time, no matter if you deploy at 9:30 or 9:50 or 10 o'clock, etc., at some point of time, due to the market momentum, you may see profit. If it is within 1:1 or 2% of your capital, it's better to book it off. So that is the inherent logic behind the all butterfly expiry day strategy without adjustments. Because to do the sell adjustments or a call sell adjustments or a put sell adjustments, you need to have more capital. So especially if you're not having more capital, then this is not, the adjustment thing will not work out. Without adjustments, you can just keep checking, but make sure that the max loss, whatever you're taking, should be within 2% of your capital, so that you need not worry. Even if the market trends heavily, you should not be worrying about it, because you know that you are not going to lose more than 2% of your capital. And how much capital it requires for one lot would be approximately 60,000 of the capital. It will be even lesser. It will be 40 or 30,000 because now the premiums are higher because we are looking for the Friday values. On expiry day values, the values will be much lesser. So your premium requirement also will go down. The funds requirement also will go down. Margin requirement. So that is the concepts. Basically, of course, like if you're a beginner in the options and just trying to attend this, it won't be clear. Some of the topics might not be clear. I'm assuming that you might be having some knowledge on the options. It's not like I'm teaching it from the very beginnings level. It's already been shared. And if there are some things which are not understood properly, now since I explained this now if you read this, maybe if somebody is not understanding previously, you may understand a little bit a better manner, like when to exit, when to book the profit, etc. kind of thing. So I mentioned and wrote clearly, it would be helpful if you are active to exit at the right time. Otherwise, you may miss the good exit opportunity. If somebody is reading this particular post without having understanding of what I mentioned, maybe he'll not be able to correlate it. Now, if I'm saying that you'll be having this range, that means if you're having this range, you need to be active whenever the market comes to this range. You need to check and close the position. That is what this line is about. So everything that I am mentioning, there will be definitely some important thing would be there. It is depending upon the person who is reading it and their knowledge, how much they are able to capture from that particular. So that was the strategy for expiry day. And there is one more important point to discuss, which is at what VIX levels this strategy can do better. In general, a VIX level of 14 or 15 or above that would be much better rather than the existing VIX levels, which is 13 or 12 like that. Because the underlying logic behind the strategy is we are trying to capture more of the at the money premiums and that we are selling. So when the premium falls much, then we'll be capturing that premium. But if the premiums are very much lesser, then the amount of premium that we're capturing will be also much lesser. So that's why in general high VIX scenarios, or at least the decent VIX, which is 14 or 15 or above that, then we can capture a decent premium. But when very low VIX scenarios like these conditions, the premium is not that much better. So better you may avoid it. To test this particular thing, whether you can deploy it or not, there is one additional hack that you can follow, which is from the strike price that you are selling, try to see the break-even points must be at least 0.3% away from the strike price where you are selling. On 0.3% upside, and 0.3% on the downside, the break-even levels must be there. It should not be within 0.2 or 0.1 like that. Minimum 0.3% from the strike price that you are selling. That means overall you will be having upside 0.3 and downside 0.3. So total it will be 0.6. So when you are having that from the at the money strike price, then you can say that the premiums are better for deployment. If you are not getting that minimum range, then it is an indication that the premiums are not better, maybe because of the low VIX scenarios, then you may avoid. So this one particular filter you can put so that you will know whether to deploy it or not. And let me know how it is working for you. Try to test it out for at least 3 to 4 weeks. Have any further questions when you are testing it out? Let me know in the comments below. And until next time, this is Arun signing off.